Hello, so this is Dave and Bart coming at you live with our final project, FinPlan, for CS50 2019. And for sakes of keeping this video around 2 minutes in length, we'll be very straight to the point and concise and explaining exactly what we have to show you here. So this website is very similar to our Finance P-Set in that it allows you to hold your own portfolio, buy and sell stocks, quote a stock, to understand what's going on in the market, except for our website emphasizes the value of your portfolio and its expected return based on the amount of risk that it carries with it. We do this, and we'll show you through a definitions page by using the price to earnings ratio of a stock, its beta, and it's the capital asset pricing model to determine its expected return. So we'll go back to the home page and show you exactly how that's applied. Essentially, when investors put money into a stock, it's based on how much how valuable the stock is right now and how much more valuable they believe it's going to be in the future. A company is valuable based on the money that it brings in, which is depicted through its earnings, and so the expected return PE essentially takes these numbers, and through crunching a little bit of math, we end up with an expected percent increase in the value of the company reflected in its stock price. We compare this number to the capital asset pricing model, which essentially says that based on the stock's beta value, which is a measure of its risk, this is how much an investor should expect to get over the course of a year, percentage-wise, in order to compensate for that risk. Because as investors take on more risky projects, they expect a higher return for such risk. You'll see that looking at this portfolio, Apple and Netflix are both good investments in that they are expected to return more percentage-wise than the risk that investors have to take on by investing in them given their beta, but Google is not, and that's because Google's expected earnings are not supposed to be much higher than they are currently, only 3%, whereas its capital asset pricing model return is 8%, which is much greater. Investors should expect a greater return based on the investment in Google, meaning that it's not worthwhile. We see through this portfolio here that the weighted average of these numbers is bad, and the reason is because we have a lot of shares of Google right here in this portfolio. Another very important part of this aspect of this website is the toggle parameters page, which actually allows you to change based on these. Keep in mind, these are all predictions as to the Fed's risk-free rate is a number right now that's determined by the central bank. That absolutely changes over time, and the market risk premium is historic. So that's based on what the